While everyone focuses on the American equity markets, a troubling situation is developing across the Atlantic in the world's third largest economy, Europe. Quietly, the economic situation has turned for the worst as rising inflation, an energy crisis, riots in the streets, and violent war have turned the once stable continent into a teetering mess on the brink of collapse. In today's video, we examine some troubling details regarding the European Union and look into a wild situation that may push many of its members to the brink. We start with the obvious. Inflation levels throughout Europe are getting dangerously high. This is especially true in some of the less developed southern and eastern states. For example, Lithuania, Estonia, Latvia, Poland, Romania, and the Czech Republic have all reported an official inflation rate above 15%, some even above 20%. At rates like this, it would take less than 4 years for prices to double, and given Europe's history, these periods of economic instability are usually met with a rise in violence, rapid political changes, and even revolution. But all of this inflation talk pales in comparison to what is happening with energy. A massive ticking time bomb has now been engaged, and if not disarmed by the winter, Europe will face its worst crises since World War II. As you have likely heard, the Europeans rely heavily on oil and gas coming from this guy, and now that this once great friendship has turned sour, this guy is threatening to turn off the taps, feeding the third largest economy on Earth. While talks of banning Russian oil and gas have circulated for months now, they have been nothing more than threats and posturing. Putin continues to pump towards the west, and although flows have diminished, they have nonetheless continued. However, starting this month, flows have been getting slashed, with Russia citing maintenance issues with various equipment. In fact, it was recently announced that the Nord Stream 1 pipeline, the EU's biggest piece of gas import infrastructure, will be closing on July 11th for maintenance. The big question on everyone's mind is obvious. Will it be turned back on, or will Putin execute a squeeze on the European energy sector, a move that threatens to completely collapse the European economy? That's not an exaggeration either. One of Germany's top union leaders was quoted saying that because of the gas bottlenecks, entire industries are in danger of permanently collapsing. That includes aluminum, glass, and chemicals. It's hard to do business and compete with the rest of the world when you're paying up to 10 times more than everyone else for basic input costs. Even without the closure of the pipeline, Germans are already facing the consequences because of the reduction in flows. The German front-year power price level has jumped to 343 euros, a price that has never before been seen in history and 6 times more than what Germans were paying historically. Javier Baez, an energy columnist at Bloomberg, took to Twitter to say that at these levels, German manufacturing would simply crumble. For more evidence of this developing situation, look no further than the TTF, an index that measures natural gas prices in Europe. The chart is absolutely breathtaking, with nat gas going essentially parabolic, trading more like a meme stock and less like a commodity, approaching numbers that were previously thought to be impossible to hit. As of the making of this video, the index is at 174 and rapidly climbing. Pre-pandemic, the level was at 13, which means that Europeans are now paying 13 times more for natural gas than what they were getting pre-pandemic and pre-invasion. To put it into perspective, think about this. The average natural gas bill in America per month is $56. Now imagine suddenly paying $700 just to keep warm. This doesn't even factor into reality that so much of the world's industrial output is reliant on natural gas. For example, gas is the essential ingredient required to produce fertilizer, and with costs skyrocketing, this market behavior eventually flows down to consumers and causes massive spikes in food costs. Some companies are already taking measures to save. In July, Bavonia, Germany's largest housing group, began to throttle its tenants' heating at night to save gas. It's really not surprising that as the situation continues to worsen, we are seeing more and more violent protests break out. In Italy, taxi drivers started a massive strike, which ended with an attempt to break into parliament. In the Netherlands, police officers fired shots at Dutch farmers who were enacting a nationwide blockade, blocking off roads, surrounding distribution centers, and causing mayhem throughout the supply chain. Supermarket shelves saw rapid depletion as the situation continued to worsen. The next day, Italian farmers were next, following in the footsteps of the Dutch. But besides the war and other rapidly increasing geopolitical risks on its borders, there is another major problem brewing. But before we get into it, please take a moment to hit that like and subscribe button if you're enjoying the content thus far. But the problem I was referencing is the Italian bond crises. Now, discussing bonds on this channel doesn't really make for great content, so I'll keep this as short and simple as possible. But it is extremely important to have a slight idea of what is going on in this specific case. You see, many believe that the next crisis lurking in the muddy waters of this wild bear market is here, in the Italian bond market. You see, Italy has a debt to GDP ratio of 150%, significantly worse than the US, which is currently at 100% and already considered a top-notch money printing abuser by most of the world. In simple terms, Italy loves to borrow money from investors to finance their wild spending habits, and in order to do so, they issue bonds for which they take in euros. Now, moving away from the technical specifics and simplifying this into one easy to understand graph, you get this: the Italy-Germany 10-year bond spread. This shows the difference in yield between the German 10-year bond and the Italian 10-year bond. Remember, these two countries use the same currency, the euro, so in effect, this graph shows how much risk there is in the Italian markets. I'm simplifying, but at its core, that's the basic premise. When this spread grows wide, everyone panics. We saw this earlier in the month when the spread got to 2.52%. It wasn't long before the ECB called for an emergency meeting to help ease the pain and implement measures to stabilize this difference. You can already see politicians in the rest of the union move to push away Italian problems. The Dutch premier recently came out and openly said that it's up to Italy to address its massive debt problem. And these comments serve as just another piece of evidence that the EU is breaking at its seams. As countries go down and economies go under, the union will come under significant pressure, where finding the political will to help depressed countries in the south and east will grow more and more difficult, both politically and economically. Unlike the United States, the massive cultural differences between each of the EU member states makes for an alliance that many speculate isn't as tight as once believed. The EU has never really been tested with a major problem affecting one of its big pieces. A default by Italy would truly stretch the limits of what Brussels is capable of, and ultimately the financial pressures of such an event could easily put the euro into serious problems. The next couple of months will be extremely important for Europe, and finding a way to manage the energy problems it is set to face during this year's winter will be the ultimate test. I would love to hear from Europeans in the comments section firsthand. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it.